Hello, everyone. Thank you for joining me today. My name is Kathleen Levito, and I'll be your host for today's webinar titled 6 Ways to Improve Your Personal Finances. Joining me today is Joe Farella, Relationship Manager for AAFMAA Wealth Management and Trust. Without further ado, I'll turn it over to Joe.
Thanks, Kathleen. Hello, everyone. I'm Joe Farella, Relationship Manager in the DC area for AAFMAA Wealth Management and Trust. Thanks for taking a minute today to walk through the 6 ways to improve your personal finances. Let's get started, shall we? A quick background on the company. This webinar is brought to you by AAFMAA Wealth Management and Trust. Our vision is to ensure the financial security and independence of members of the armed forces community, active, retired, and honorably discharged service members and their families. We accomplish this as the premier provider of financial planning, investment management, and trust services for all branches of the military. Also, a few disclosures. This presentation is educational. It is for general information only and not specific investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial planning decisions. Since each individual situation is unique, your needs for financial services will differ. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. We have highlighted here 2 distinct characteristics that separate AAFMAA Wealth Management and Trust from other service providers. Our fiduciary standard to what is in the best interest of the client and exclusively serving the U.S. Armed Forces community. You know, with the end of the year approaching, it's a great time to ask yourself if your financial house is in order, and then take the steps to improve your personal finances. Today, we're going to cover my top 6 items that you should consider. First, review your goals and reprioritize as necessary. Establishing goals is the prerequisite for getting where you want to be, and it's important to take the time to define your family's financial goals with your spouse for next year. Ask yourself, what are my financial priorities? What are my short-term and long-term goals? Short-term goals, such as planning for a vacation, or long-term goals, such as early retirement. Is a particular budget category consistently over budget? When is the last time that you looked at your investments or reviewed your insurance policies? Are there any unusually large bills next year, such as college tuition or a new roof? Review your asset allocation. Asset allocation is a common strategy that you can use to construct and manage your investment portfolio. Asset allocation isn't about picking individual securities. Oh no. Instead, it's focusing on broad categories of investments, mixing them together in the right proportion to match your financial goals, the amount of time you have to invest, and your tolerance for risk. So how tolerant are you of market risk? To understand your risk tolerance or how much risk you are willing to take, you first need to consider your time horizon and personal financial goals. The other aspect of risk tolerance is risk capacity, which is how much risk you can or cannot afford to take. Life events such as marriage, divorce, career changes, and retirement are just some examples of factors that should prompt an individual to reassess their risk tolerance. Different classes of assets carry different levels of risk and potential return. The idea behind asset allocation and diversification is that because not all investments are alike, you can balance risk and return in your portfolio by spreading your investment dollars among different types of assets, such as stocks, bonds, and cash alternatives. It doesn't guarantee a profit or insure against the loss, of course, but it can help you manage the level and type of risk you face. Here's a look at the 3 major classes of assets you'll generally be considering when you use asset allocation. First, stocks. Although past performance is no guarantee of future results, stocks have historically provided a higher average annual rate of return than other investments, including bonds and cash alternatives. However, stocks are generally more volatile than bonds or cash alternatives. Investing in stocks may be appropriate if your investment goals are long-term. Bonds. Historically less volatile than stocks, bonds do not provide as much opportunity for growth as stocks do. They are sensitive to interest rate changes. When interest rates rise, bond values tend to fall. And when interest rates fall, bond values tend to rise. As a result, bonds redeemed prior to maturity may be worth more or less than their original cost. Because bonds typically offer fixed interest payments at regular intervals, they may be appropriate if you want regular income from your investments. Third, cash alternatives. Cash alternatives, or short-term instruments, offer a lower potential for growth than other types of assets, but are less volatile. They are subject to inflation risk, the chance that returns won't outpace rising prices. They provide easier access to funds than longer-term investments and may be appropriate for investment goals that are short-term. Build or reassess your portfolio. Choose specific investments for your portfolio that match your asset allocation strategy. This is much less important than the asset allocation question, but also more complex because of the virtually unlimited investment options that exist. Mutual funds and ETFs make this step easier by providing automatic diversification, professional management, and potentially lower costs. When building and reviewing your portfolio, be sure to look at all of your assets as a whole to help you understand not only your allocation and objective for one particular account, but how your entire investment portfolio is allocated. Pay attention to your portfolio. It is important to revisit your allocation and or rebalance your portfolio at least once a year, or more often if markets are experiencing greater short-term fluctuations. Because of market fluctuations, your portfolio may no longer reflect the initial allocation balance that you chose. For instance, if the stock market has been performing well, eventually you'll end up with a higher percentage of your investment dollars in riskier stocks than you initially intended. To rebalance, you may want to shift funds from one asset class to another. This slide is applicable to those who are not yet in retirement. You may have a very idealistic vision of retirement, doing all the things that you never seem to have time to do now. But how do you pursue that vision? Social Security may be around when you retire, but the benefit that you get from Uncle Sam may not provide enough income for your retirement years. To make matters worse, few employers today offer a traditional company pension plan that guarantees you a specific income at retirement. On top of that, people are living longer and must find ways to fund those additional years of retirement. Such eye-opening facts mean that today, sound retirement planning is critical. But there's good news. Retirement planning is easier than it used to be, thanks to the many tools and resources available. Here are some basic steps to get you started. Determine your retirement income needs. It's common to discuss desired annual retirement income as a percentage of your current income. Depending on who you're talking to, that percentage could be anywhere between 60 to 90%, or even more. The appeal of this approach lies in its simplicity. The problem, however, it doesn't account for your specific situation. Use your current expenses as a starting point, but note that your expenses may change dramatically by the time you retire. If you're nearing retirement, the gap between your current expenses and your retirement expenses may be small. If retirement is many years away, the gap may be significant, and projecting your future expenses may be more difficult. Remember, take inflation into account. The average annual rate of inflation over the past 20 years has been approximately 2%. And keep in mind that your annual expenses may fluctuate throughout retirement. For instance, if you own a home and you're paying a mortgage, your expenses will drop if the mortgage is paid before retirement. Other expenses, such as health-related expenses, may increase in your later retirement years. A realistic estimate of your expenses will tell you about how much yearly income you will need to live comfortably. Calculate the gap between needs and estimated future income. Once you've estimated your retirement income needs, Take stock of your estimated future assets and income. These may come from Social Security, a retirement plan at work, a part-time job, and other sources. If estimates show that your future assets and income will fall short of what you need, the rest will have to come from additional personal retirement savings. If you calculated a gap between needs and future income, figure out how much you're going to need to save. But exactly how much is enough? The following question may help you find the answer. Ask yourself, at what age do you plan to retire? The younger you retire, the longer your retirement will be, and the more money you'll need to carry you through it. What is your life expectancy? The longer you live, the more years of retirement you'll have to fund. What rate of growth can you expect from your savings now and during retirement? Be conservative when projecting rates of return. Do you expect to dip into your principal? If so, you may deplete your savings faster than if you just live off the investment earnings. Build in a cushion to guard against these risks. Build your retirement fund. Save, save, save. When you know roughly how much money you'll need, your next goal is to save that amount. First, you'll have to map out a savings plan that works for you. Assume a conservative rate of return, let's say 5 to 6%, and then determine approximately how much you'll need to save every year between now and your retirement to reach your goal. It's never too early to get started. To the extent possible, you may want to arrange to have certain amounts taken directly from your paycheck and automatically invested in accounts of your choice, i.e. 401k plans, payroll deduction savings. This arrangement reduces the risk of impulsive or unwise spending that will threaten your savings plan. Out of sight, out of mind. If possible, save more than you think you'll need so you can provide yourself a cushion. Understand your investment options. You need to understand the types of investments that are available and decide which ones are right for you. If you don't have the time, energy, or inclination to do this yourself, then hire a financial professional. He or she will explain the options that are available to you and will assist you in selecting investments that are appropriate for your goals, risk tolerance, and time horizon. The following are among the most common retirement saving tools, but others are also available. Employer-sponsored retirement plans that allow employee deferrals, such as the TSP, like 401k, 403b, Simple, and 457 plans, are powerful saving tools. Your contributions come out of your salary as pre-tax contributions, reducing your current taxable income, and any investment earnings are tax deferred until withdrawn. These plans often include employer matching contributions and should be your first choice when it comes to saving for retirement. TSP, 401k, 403b, and 457 plans can also allow after-tax Roth contributions. While Roth contributions don't offer an immediate tax savings, qualified distributions from your Roth account are federal income tax free and are not subject to required minimum distributions. These accounts have maximum annual contribution amounts and allow for catch-up contributions for those age 50 and above. In addition to your employer-sponsored retirement savings plan, you can also contribute to a traditional IRA or Roth IRA of up to $6,000 or $7,000 for those age 50 and above. For both the Roth and deductible traditional IRA contributions, the eligibility is based on income. Before contributions are made, please be sure to verify eligible income brackets. If you are eligible, traditional IRAs may enable you to lower your current taxable income through deductible contributions, and earnings are tax deferred. Withdrawals, however, are generally taxable as ordinary income. Roth IRAs don't permit tax-deductible contributions, but they do allow you to make completely tax-free withdrawals under certain conditions. With both types, you can typically choose from a wide range of investments to fund your IRA. Finally, annuities. Annuities are contracts issued by insurance companies. Annuities are generally funded with after-tax dollars, but their earnings are tax-deferred. you pay tax on the portion of distributions that represents earnings. There is generally no annual limit on the contributions to an annuity. A typical annuity provides income payments beginning at some future time, usually retirement. The payments may last for your life, for the joint life of you and a beneficiary, or for a specified number of years. Guarantees are subject to the claims paying ability of the issuing insurance company. Annuities may be subject to certain charges and expenses, including mortality charges, surrender charges, administration fees, and other charges. For those of you already in retirement, by now, hopefully you've already taken all of your requirement minimum distributions. If not, be sure to do so before December 31st to avoid penalty. You must take your first RMD for the year in which you turn 70 and a half. However, the first payment can be delayed until April 1st of the year following the year in which you turn 70 and a half. Add up your IRAs. To determine your RMD amount, be sure to add up all of your traditional IRA accounts when determining your IRA RMD amount. The value on December 31st, 2018 will be used along with the divisor according to the appropriate IRS life expectancy table. Figure your withdrawal amount. In retirement, one of the biggest risks is outliving your assets. It's important to determine a safe withdrawal amount to mitigate against longevity risk. This can be estimated using financial retirement calculators, but we always recommend you seek professional advice to help assist you. Avoid tax penalties. None of us want to pay any more taxes than we already do, so be sure to take your RMD on time to avoid penalties. If an RMD is not taken in the required year, the amount not withdrawn is taxed at 50%. Yee. Decide on a source. An overlooked component to RMD withdrawals is determining which investments you should sell or draw from. Consider factors such as risk tolerance, taxes, income needs, and current economic conditions. Lastly, monitor your withdrawal amount. IRS rules tell you how much you must withdraw, but not how you should withdraw to accomplish your financial goals. As the end of the year approaches, it's time to consider strategies that help you reduce your tax bill. But most tax tips, suggestions, and strategy are of little practical help without a good understanding of your current tax situation. This is particularly true for year-end planning. You can't know where to go next if you don't know where you are now. So take a break from the holiday chores, pull out your last year's tax return along with your current pay stubs and account statements. A few quick projections will help you estimate your present tax situation and identify any glaring issues you'll need to address while there's still time. When it comes to withholding, don't shortchange yourself. If you project that you'll owe a substantial amount when you file this year's income tax, ask your employer to increase your federal income tax withholding. If you have both wage and consulting income and are making estimated tax payments, there's an added benefit to doing this. Even though the additional withholding may need to come from your last few paychecks, it's generally treated as having been withheld evenly throughout the year. This may help you avoid paying an estimated tax penalty due to underwithholding. Of course, if you significantly overpaid your taxes and estimate you'll be receiving a large refund, you can reduce your withholding accordingly, putting money back in your pocket this year instead of waiting for your refund check to come next year. Timing is everything. The last few months of the year may be the time to consider delaying or accelerating income and deductions, taking into consideration the impact on both this year's taxes and next. If you expect to be in a different tax bracket next year, doing so may help you minimize your tax liability. For instance, if you expect to be in a lower tax bracket next year, you might want to postpone income from this year to next year, so you'll pay taxes on it next year instead of now. At the same time, you may want to accelerate your deductions in order to pay less tax this year. To accelerate deductions into this year, consider paying medical expenses in December rather than January, if doing so will allow you to qualify for the medical expense deduction. Prepaid deductible interest. Make alimony payments early. Make next year's charitable contributions this year. The alternative to bunch future donation so that every few years it is possible to surmount the higher threshold and use a deduction. Consider prepaying your taxes, state and local taxes for 2020 if your local tax authority will allow it. For those who exceed the $10,000 state and property tax return deduction, it may be beneficial to contact your local tax authority to determine if they will accept prepayments of 2020 property tax. It's worth the phone call. To delay income to the following year, you might be able to defer year-end bonuses, defer the sale of capital gain property, or take installment payments rather than a lump sum payment. Postpone receipt of distributions, other than requirement minimum distributions, from retirement accounts. Postpone considering Roth conversions. The gifts that you give back. Now is a good time to consider making non-charitable gifts. You may give up to $15,000, twice that amount for a married couple, to as many individuals as you want without incurring any federal gift tax consequences. If you gift an appreciated asset, you won't have to pay tax on the gain. Any tax is deferred until the recipient of your gift disposes of the property. Postpone the inevitable. Recall tip number 3, contributing to your retirement plans. To reduce your taxable income this year, consider maximizing pre-tax contributions to an employer-sponsored retirement plan, such as a 401k. You won't be taxed on the contributions you make now, and you may be in a lower tax bracket when you do eventually withdraw the funds and report the income. If you qualify, you might also consider making either a tax-deductible contribution to a traditional IRA. You'll generally have until the due date of your federal income tax to make these contributions. Tax planning can be complicated, folks. Consider seeking the assistance of a tax professional to determine what year tax planning moves, if any, are right for your individual circumstance. As a certified financial planner, the topic that is most dreaded but most necessary is your budget. It is a vital part of planning and financial success. That being said, with the new year just a few weeks away, I encourage you to ask yourself, when is the last time you created a budget? If you have never created a budget or haven't taken a recent look at yours, you may want to establish a budget to help you keep track of how you spend your money and help you reach your financial goals. First, let's talk a little bit about how to create a budget. For simplicity, I'm going to break it down in just a few easy steps. 1, let's examine your financial goals. Start by making a list of your short-term goals, i.e., I want to buy a new car, go on a vacation, and your long-term goals, your child's college education, retirement planning. Next, ask yourself, how important is it for me to achieve this goal? How much will I need to save? Armed with a clear picture of your goals, you can work towards establishing a budget that can help you reach them. Identify your current monthly income and expenses. Creating a budget that works for you is key. Use whatever method you will find sustainable, whether that be a pen and paper, Excel spreadsheet, or a software program such as Quicken, doesn't matter. I'll spend some time on the last slide talking about a software program we offer complimentary called Financial Dashboard. Start by adding up all of your income to include salary and wages and other types such as dividends, interest, and child support. Next, add up all your expenses. Break down your expenses into fixed, flexible, and occasional expenses. Fixed expenses are bills such as rent and mortgage, car payments, utilities, insurance, and monthly savings, because remember, we have to pay ourselves first. Flexible expenses are entertainment, household goods, gas, and hobbies. Occasional expenses are items you purchase periodically, such as gifts, vacations. Be sure to include expenses from all spending accounts, including credit cards. Next, evaluate your budget. Once you've added up all your income and expenses, compare the two totals. To get you ahead, you should be spending less than you earn. If this is the case, you're right on track, and you need to look at how well you use your extra income. If you find yourself spending more than you earn, you'll need to make some adjustments. Look at your expenses closely and cut down on your discretionary spending. Monitor your budget. You'll need to monitor your budget periodically and make changes when necessary. It's important to keep reasonable track of expenses, but keep in mind that you don't have to keep track of every penny that you spend. Perish the thought. And remember, be flexible. Any budget that's too rigid is likely to fail. So be prepared for the unexpected, i.e., a leaky roof, failed car transmission. You get the idea. Here are some quick tips on staying on track when it comes to budgeting. Involve the entire family. Agree on a budget up front and meet regularly to check your progress. As discussed, there are many formats of budgets. Choose the best one for you. Stay disciplined. Try to make budgeting a part of your daily routine. Start your new budget at a time when it will be easy to follow and stick with the plan, i.e. at the beginning of the year as opposed to right before the holidays start. Find a budgeting system that fits your needs. Again, I can't overemphasize that enough. Distinguish between expenses that are wants, i.e. designer shoes, a top-of-the-line suit, and expenses that are needs, groceries, etc. Build rewards into your budget, i.e. eat out every other week. Avoid using credit cards to pay for everyday expenses. If you do use credit cards for everyday expenses to redeem rewards, cash backs, or other benefits, be disciplined and pay those amounts off each month. Here's my final recommendation, folks. Invest extra income. Investing extra income may seem like a no-brainer, but for many this can be difficult. I want to first address saving versus investing, and then I'll review some helpful tips on how to invest more. You must plan to invest. Why do so many people never obtain the financial independence that they deserve? Often it's because they just don't take that first step, getting started. Besides procrastination, other excuses people make are that their investing is too risky, too complicated, too time-consuming. It's only for the rich. The list goes on and on. The fact is, there's nothing complicated about common investing techniques, and it usually doesn't take much time to understand the basics. One of the biggest risks you face is not educating yourself about which investment may be able to help you pursue your financial goals and how to approach the investing process. Saving versus investing. Both saving and investing have a place in your finances, but do not get the two confused. Saving is the process of setting aside money to be used for a financial goal, whether that is done as part of a workplace retirement savings plan, an individual retirement account, a bank savings account, or other savings vehicle. Investing is the process of deciding what you do with those savings. Why invest? You invest for the future, and the future is expensive. For example, because people are living longer, retirement costs are often higher than many people expect. You have to take responsibility for your own finances, even if you need expert help to do so. As discussed in the beginning of this presentation, government programs such as Social Security will probably play less a significant role for you than they did for previous generations. Corporations are switching from guaranteed pensions to plans that require you to make contributions and for you to choose the investments. The better you manage your dollars, the more likely it is you'll have the money to make the future that you want it to be. Because everyone has different goals and expectations, everyone has different reasons for investing. Understanding how to match those reasons with your investments is simply one aspect of managing your money to provide a comfortable life and financial security for you and your family. So, before you start, organize your finances to help manage your money more efficiently. Remember, investing is just one component of your overall financial plan. Get a crystal clear picture of where you are today. What's your net worth? Compare your assets with your liabilities. Recall recommendation number 5, update your budget. Look at your cash flow. Be clear on where your income is going each month. List your expenses. You can typically identify enough expenses to account for at least 95% of your income. If not, go back and look at it again. You could use those lost dollars for investing. Are you drowning in credit card debt? If so, pay it off as quickly as possible before you start investing. Every dollar that you save in interest rate charges is one more dollar that you can invest for your future. Establish a solid financial base. Make sure you have an adequate emergency fund, sufficient insurance coverage, and a realistic budget. What is the best way to invest? Well, get in the habit of saving. Set aside a portion of your income regularly. Automate that process if possible by having money automatically put into your investment account before you have a chance to spend it. Invest so that your money at least keeps pace with inflation over time. Do not put all of your eggs in one basket. Recall recommendation number 2. Review your asset allocation. Though asset allocation and diversification don't guarantee a profit or insure against the possibility of loss, having multiple types of investments may help reduce the impact of a loss on any single investment. Focus on long-term potential rather than short-term price fluctuation. Ask questions and become educated before making any investment. Invest with your head, not with your stomach or your heart. Avoid the urge to invest based on how you feel about an investment. Understand the impact of time. Take advantage of the power of compounding. Compounding is the earning of interest on interest, or the reinvestment of income. Use the rule of 72 to judge an investment's potential. Divide the projected return into 72. The answer is the number of years it will take for that investment to double in value. For example, an investment that earns 8% a year will double in 9 years. Consider whether you need expert help. If you have the time and energy to educate yourself about investing, you may not feel you need assistance. However, for many people, especially those with substantial assets and multiple investment accounts, it may be worth getting expert help in creating a financial plan that integrates long-term financial goals such as retirement with other more short-term needs. Review your progress. Financial management is an ongoing process. It's not done overnight. Keep good records and recalculate your net worth annually. This will help you for tax purposes and show you how your investments are doing over time. And finally, here are a few extra tips that will help you invest more. Pay yourself first. Repeat, pay yourself first. Set up automatic deductions from your paycheck that go into investment accounts and use the remainder to pay for current living expenses. If you are managing your budget well at your current income level, don't spend windfall income. Invest your tax returns and bonuses. Diversify your income stream. Family dependence on one paycheck is risky. What happens to your budget and investment plan if you lose your job? As a family, think creatively about additional income streams that you can create for your family, such as getting a second job, starting a consultant business, or renting out assets you own. Once that additional income is flowing in, invest it. So folks, today we covered 6 ways to improve your personal finances. Many of the topics we covered today are simple approaches to assist with organization and accountability of your own financial future. With the end of the year closely approaching, there is no better time to get organized and plan ahead for a successful 2020. We offer a helpful and comprehensive tool to help with many of the discussion points reviewed today, the AAFMAA Wealth Management Trust Financial Dashboard. This is an online tool from eMoney, the same software we use for all our comprehensive plans. Access to the financial dashboard is secure and at no cost to those eligible for AAFMAA membership. It is a great tool that we offer to help you be more successful. Through use of the financial dashboard, you can create a customized budget to help you control spending, securely track asset gains and losses in real time across your entire portfolio, monitor your asset allocation and net worth, and manage cash flow by setting custom alerts. The financial workshop provides videos and articles along with calculators on asset allocation, budgeting, retirement planning, college savings, and insurance planning. You can request access to the financial dashboard by clicking on the above link. As the new year approaches, we encourage you to think about your financial plan. If you have not yet created a financial plan and would like to know more about our planning process, I encourage you to reach out to any of us here at AAFMAA Wealth Management and Trust. We are happy to help.
All right, thank you, Joe. We'll go ahead and break here for now, but please don't hesitate to reach out to us for assistance whenever you need it. You can see Joe's contact information here on the slide, as well as contact information for AAFMAA Wealth Management and Trust. And this weekend, you'll receive a follow-up email with instructions on how to access a recording of this presentation. And you can always register for future webinars and review past webinars at afma.com/webinars. If you found this information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce those in your military community to AAFMAA. Thank you again to everyone listening for joining us today. We look forward to our next opportunity to assist you.